Hello, everyone, and welcome to Gold Off the Charts. We're here every day to bring you sharp financial perspectives, helping you cut through the noise and see the true nature of wealth. I'm not exaggerating when I say that in today's video, we are witnessing history. If you open your trading app right now and look at the price of silver, your palms might start to sweat. This isn't a drill. We are in the middle of a massive metal frenzy. As we're recording this, the precious metals market is seeing a rare split in trends. Gold is still holding strong at over $4,500, acting like a steady, reliable leader. But silver? Everyone, silver has gone absolutely wild. It's defied gravity and entered a massive short squeeze all on its own. On December 26th, silver skyrocketed 10% in a single day. And today, the madness continued. It spiked during the session to hit an all-time record high of $84. $84! Just a few years ago, that number was unthinkable. However, today, December 29th, the market threw a bucket of cold water on everyone's excitement. Right after hitting that $84 peak, the price of silver took a violent turn. At one point, it plunged nearly 10%, almost wiping out all of today's gains. What's behind this roller coaster market? Why is there so much chaos today? Is this silver bull market ending, or is it just getting started? Today, I'll help you look beneath the surface of this madness to find the truth behind this high-stakes game. First, we need to understand the immediate cause of today's sudden cliff dive. It wasn't because the fundamentals changed or demand vanished, it's because an invisible hand stepped in. The CME Group, the world's largest exchange for these types of trades, issued a massive announcement on December 26th, starting December 29th, essentially after today's close. The margin, the deposit required to trade for gold, silver, and lithium will be hiked across the board. Simply put, the exchange is nervous. This silver rally is one of the biggest short squeezes in history. Prices rose too fast and too hard, and the volatility has reached a point where the clearinghouses are losing sleep. Raising the margin makes it more expensive to trade, which forces the market to cool down. It forces traders who are over-leveraged, trading with too much borrowed money, to close their positions. When this news hit, the market's nerves were on edge. Historically, when exchanges hike margins like this, it usually happens when market excitement is at its peak and prices are near a temporary top. We'll dive deeper into that later. So, today's drop was essentially smart money getting out before the new rules kicked in. They chose to take their profits and avoid the uncertainty. But here's the big question. Does this change silver's long-term path? Can it keep rising? This brings us back to my core logic. As I mentioned in our last video, this rally isn't just driven by hype, it's driven by a real physical shortage. Let's look at some critical data. These numbers explain why buyers are still brave enough to jump in even at $80 despite the CME's moves. Recent reports show the silver market is in a structural deficit, and that gap is getting wider. On the demand side, by 2025, total global demand for silver hit a massive 12.4 billion ounces. Why is it so high? Because silver is no longer just a shiny metal. It's the lifeblood of green energy. It's used in solar panels, electric vehicles, high-end electronics, and AI data centers. All of these tech hubs need silver. Industrial demand now accounts for 50% to 60% of all silver used. What does this mean? It means this demand is non-negotiable. Whether silver is $50 or $80, a solar panel manufacturer must buy it to keep production lines moving. You can't stop that kind of demand just by raising the price. Now, look at the supply. Total global silver supply in 2025 is expected to be only 10.1 billion ounces compared to that 12.4 billion ounce demand. Do the math. 12.4 minus 10.1, how big is that gap? It's roughly 2.3 billion ounces. Estimates vary, but we are looking at a massive shortfall equivalent to a fifth of global production just vanishing. To make matters worse, this supply gap is structural, meaning it can't be fixed quickly. Why? Because there are very few pure silver mines. 70% of silver is actually a byproduct of mining copper or zinc. This creates a weird situation. Even if silver prices go through the roof, mining companies won't dig more unless copper and zinc prices rise too. Plus, it takes 10 years to build a new mine. So, how much is left in the vaults? This is the scary part. Since 2020, silver inventories at the COMEX have dropped 70%, and London's vaults are down 40%. At today's crazy consumption rate, some regions only have enough physical silver to last another 30 to 45 days. That's why I call it a supply-demand black hole. Industry is hoarding it, investors are grabbing it, and we can't dig it out of the ground fast enough. A small margin hike by the CME won't fix a fundamental flaw like that. Beyond supply and demand, there's a financial time bomb. The massive gap between paper silver and physical silver. Most silver traded on markets is just paper, meaning it's just contracts and certificates. Industry estimates suggest the ratio of paper trades to physical silver is 356 to 1. Think about that for a second. For every single ounce of physical silver in a vault, there are 356 people holding a piece of paper claiming they own it. Usually, that's fine, because everyone is just betting on price changes. But in a shortage, this is a crisis waiting to happen. If even 1% of those buyers, like a giant solar company or a wealthy family, suddenly says, "I don't want the cash, I want the actual silver bricks delivered," the system breaks, there isn't enough silver to go around. This is why prices are going vertical. Banks and big institutions are actually more panicked than retail investors. They are scrambling to buy back silver to cover their short positions before a run on the bank happens. So, back to today's 10% drop. Why did it recover so fast? Because for people who need the actual metal, any price drop is a sale they have to take. Even though the long-term outlook is solid, we can't ignore the CME's margin hike. Historically, this is a signal that the party is reaching a fever pitch or a temporary peak. Look at 2011. When silver hit $50, the CME raised margins 5 times in 9 days. The result? The price collapsed and stayed in a bear market for years. Look at 1980. The famous Hunt brothers tried to corner the market and silver hit $50, which was huge back then. The exchange stepped in, restricted trading, and hiked margins. It wiped the Hunt brothers out, and the price came crashing down. History doesn't always repeat, but it often rhymes. When exchanges start capping leverage, it's a sign that regulators are worried about the risks of a one-way market. This is a clear order to cool down. If you're using high leverage to buy right now, you are fighting against the rules of the exchange. While the industrial demand makes this time different from 2011 or 1980 and might keep prices higher for longer, the short-term swings can be terrifying. Today's 10% flash crash was just a preview. The battle between buyers and sellers will be intense over the next few days. So, with great long-term potential, but scary short-term risk, what should an average investor do? Here are 3 tips. First, don't fall for FOMO, fear of missing out. Never chase a high. I know it's hard to watch it go up 10% in a day, but silver is a notorious roller coaster. Even in a bull market, it can drop 10% or 20% in the blink of an eye. If you buy at $84 and it drops to $70 before going to $100, you were right about the direction, but your account might be wiped out at $70 if you're using leverage. Second, buy the dips in small batches. Now is not the time to go all in to stud. Be like a crocodile. Stay patient. Wait for a sharp, news-driven drop like we saw today. When the market panics and prices fall, that's your chance to buy physical silver or low-risk positions bit by bit. Third, manage your position size. Mindset is everything. This is a historic market move. It won't end in a day. Don't try to get rich overnight. Keep your trade sizes small so you don't run out of cash too soon. This allows you to stay calm during the swings. If there's a deep pullback, you'll have the funds to average down rather than being forced to quit. Let's wrap up what we know. Silver is highly volatile after hitting $84. The CME margin hike is the main reason for today's cooling off period. The hardcore reason silver keeps bouncing back is the 356 to 1 paper to physical gap and the massive supply shortage. The bull market still has legs. Strategy-wise, expect brutal short-term swings. The best move is to buy small amounts during price drops. The worst move is to panic buy at the top. We are witnessing a historic wealth transfer opportunity for our generation. But with great opportunity comes great risk. The storm is just starting. Protect your capital. In this market, surviving is more important than winning big. This analysis is just my personal opinion and isn't financial advice. Trading is risky, so please do your own research and make decisions based on your own risk tolerance. That's it for today! If this was helpful, please like, subscribe, and hit the bell icon so you don't miss the next update. This is Gold Off the Charts. See you in the next one. Later.